How to use covered call writing to generate income and build wealth. If you're an investor looking to maximize income from your existing stock holdings without taking on excessive risk, covered call writing is a strategy worth exploring. This approach allows you to collect extra cash flow from stocks you already own and can even add a level of protection against market downturns. Over time, this added income can significantly enhance your wealth-building efforts. In this article, we'll cover the basics of covered call writing, the benefits of this strategy, how it works, and the key considerations to keep in mind as you get started. What is covered call writing? A covered call is an option strategy where you, as a stockholder, sell the right or option for someone else to buy your stock at a specific price, known as the strike price, within a certain time frame. In return for this option, the buyer pays you a premium upfront. The catch? If the stock's price rises above the strike price by the expiration date, you may have to sell it at that strike price, regardless of how high the stock has risen. Example of a covered call. Let's say you own 100 shares of XYZ stock, which currently trades at $50 per share. You sell a call option on those shares with a strike price of $55, expiring in 30 days. The buyer of the call option pays you a $2 premium per share. You collect $200 in premium, 100 shares times $2 per share, right away. Now, regardless of what happens to XYZ's price, that premium is yours to keep. If the stock stays below $55 by expiration, the option expires worthless, and you retain both your shares and the premium. If the stock rises above $55, you may have to sell it at that price, giving up some potential gains, but still profiting from the sale, plus the premium received. Why covered call writing works for income and wealth building. The beauty of covered call writing lies in its ability to generate income while still allowing you to keep most of your stock's upside potential. Here are some reasons why this strategy can be a powerful tool for income generation and wealth building. Immediate cash flow. When you write a covered call, you receive a premium up front. This cash payment can be viewed as immediate income, which you can reinvest, use for expenses, or save as a cushion against future losses. Risk reduction. Covered call writing reduces your break-even point. In our example, since you collected a $2 premium, your effective cost basis on the stock drops from $50 to $48. If the stock declines slightly, this buffer can minimize or offset potential losses. Boosts returns on your holdings. For investors in slow growth or dividend-paying stocks, covered call writing can amplify returns. By writing calls regularly, you create an additional income stream, which over time can lead to compounded wealth growth. How to write covered calls. If you're ready to start generating extra income through covered call writing, here's a step-by-step guide to setting up your first trade. Step 1. Choose the right stock. Select a stock you already own, or one you're willing to own. Ideally, you want a stock that you expect to stay relatively stable or grow slowly in the near term. Fast-moving growth stocks can result in the stock price moving above your strike price, potentially triggering the option and causing you to sell your shares. Step 2. Decide on the strike price. The strike price is the price at which you'd be willing to sell your stock if the call option is exercised. For instance, if your stock is trading at $50, you might set the strike price at $55. This allows you to retain upside potential while generating income. Many investors choose a strike price that is around 5 to 10% higher than the current stock price to maximize returns without risking an immediate sale. Step 3. Select an expiration date. Choose a time frame for your call option. Expiration dates can range from days to months. Shorter-term options allow you to collect premiums more frequently, while longer-term options tend to offer higher premiums but are less flexible. Many investors use a 30-day window as it balances income potential with flexibility. Step 4. Place the trade. Once you've selected your strike price and expiration date, place the call option trade through your brokerage account. Make sure you're aware of any commission fees, as these can impact your net income from the strategy. Key considerations and risks in covered call writing. While covered call writing can be a valuable income generation tool, it's important to understand the associated risks and trade-offs. Risk of losing out on significant gains. If the stock price surges well above the strike price, you may have to sell it at a lower price than you'd like. While you do collect the premium and possibly gain from the sale price, you might miss out on the larger upside. For instance, if your stock jumps from $50 to $60, but you wrote a $55 call, you lose out on the additional $5 per share gain above the strike price. Market downturns. While covered calls can reduce your break-even point, they won't protect you from large declines in stock value. If your stock drops below your adjusted cost basis, you'll still incur a loss, albeit a smaller one thanks to the premium collected. Time commitment and monitoring. Covered calls require regular monitoring, as you'll need to roll or close out positions as expiration dates near. Active management ensures you maximize income while adapting to changes in stock price. Maximizing wealth with covered call writing. By using covered call writing consistently, you can build a steady income stream that enhances your overall wealth. Here's how you can incorporate covered call income into your long-term wealth building plan. Reinvest your premiums. Take the premiums you collect from writing covered calls and reinvest them. This could be in additional shares of the same stock, different stocks, or even other asset classes. Over time, this compounding effect can accelerate your wealth growth. Add a buffer for long-term holdings. If you're holding dividend-paying stocks for income, covered calls can add an extra layer of income without impacting your core holdings. The premium acts as a bonus income stream in addition to the dividends you're already collecting. Use covered calls on retirement accounts. Some retirement accounts, like IRAs, allow for covered call writing. This lets you generate extra income within a tax-advantaged account, which can be reinvested or used to boost retirement savings. Final Thoughts Covered Call Writing is an accessible, relatively low-risk strategy for generating extra income while still holding onto your stocks. When managed correctly, it can add consistent cash flow to your portfolio, helping you accumulate wealth over time. Remember that, like all investment strategies, covered call writing comes with trade-offs and risks. It's essential to choose the right stocks, set appropriate strike prices, and actively manage your positions to maximize benefits. By doing so, you can tap into the power of covered calls to generate passive income and steadily grow your wealth. Ready to give it a try? Start small, test the waters, and see how covered call writing can make a difference in your portfolio. Happy investing!